to today's webinar, the Smart Investors 2026 Guide to Crypto, presented by AAII and Unchained. Thank you so much for joining us. We're really happy to have you all here. And my name is Jennifer Shear, and I'll be your host for today. We're really glad to be here this afternoon with our new partner, Unchained, and we can't wait to dive into the topic of cryptocurrency and digital assets. But before we begin, there are a few things I'd like to go over. First off, I want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And please be sure to keep an eye on the chat throughout the webinar. I'll share some helpful links and resources throughout the event. And then if you have any questions for our speakers during the presentation, please submit them using the question section of your GoToWebinar control panel. And then once our presentation concludes, our moderator, Charles, will select a few for our presenters to answer. And then if your question isn't selected during the broadcast, feel free to email us at bitsbips@aaii.com. And then we have a special promo flyer and a very short slide deck with some info and resources. And that's uploaded in the handout section of your GoToWebinar control panel. And that's located on the right-hand side of your screen. And then if you experience any issues with the audio or the video of the webinar, please consult the GoToWebinar website for support at gotowebinar.com. And then just a friendly reminder that this presentation is recorded and a replay will be available to all who attended today. The handouts and recording will be accessible at aaii.com/webinars. And I'll put that in the chat later. And then for new viewers, we always like to give a little background about our organization. So the American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. And with that, I'd like to hand over the presentation to Charles.
Thanks, Jenna. Thanks, everyone, for joining us today. Today, we're joined with Laura Shin and Steve Ehrlich of Unchained. Hi, Laura. Hi, Steve.
Hi.
Great to have you.
Excited to be here.
Hey, everybody.
Yeah, we're great to have you as well. So Laura and Steve are experts on crypto. Laura, some of you might be familiar with Steve. He's written some articles for the AAII Journal, presented at our 2021 conference. Steve formerly worked at Forbes. Laura also started covering crypto when she was at Forbes. She actually also started Unchained, has a very good podcast, and Laura's actually one of the first journalists to really cover crypto in an objective, serious way. And both she and Steve have developed quite a lot of expertise about crypto, not just Bitcoin, but the entire crypto space. And they are both here to share some knowledge with us.
Yeah, excited to dive in.
Great. Let me just start out here with, let's talk with the key concept, Laura, you and I talked about before, and that's decentralization. It's central to crypto. Could you explain what it is and why it matters, particularly to people who either don't fully understand it or don't understand it at all?
Yeah, the reason why I wanted to talk about this is because, as you can imagine, when I tell people what I do, I often come across certain misconceptions that are popularly held. And I felt like this was a key concept that people needed to understand in order to understand what makes crypto different from a different type of asset that they might be more familiar with, like a stock. So, because I've had people say to me things like, oh, I want to buy Bitcoin stock or whatever. And it makes me realize, like, okay, so they need to understand kind of why crypto is revolutionary and what this technology actually offers that's different and distinctive from what has come before in financial assets. So I want to just give a very analog example of what Bitcoin is. And so let's imagine that every single person in this webinar is part of a village. And I don't know how many people are in here, maybe like, I think about 600. So we have a village of 600. And our financial system is one where we gather in the town square every day. And let's say that time is noon every day. And we will all call out all of the financial transactions we had since the day before, so in the past 24 hours. So when I call out what transactions I had, every single person in the village, all 600 people, will write down the transactions. So if I say, like I paid Steve $20 to give me a ride to the airport or whatever, then people will all write it down on their ledgers. And let's say that one day Steve is sick, and so when he gets over his illness, he comes back and his ledger looks different from everybody else's. We decide that there isn't one single person that is in charge of making sure the ledger is correct, because essentially that's kind of what banks are doing nowadays for us, right? They're kind of like in charge of maintaining these ledgers, right? What we decide is that the correct ledger doesn't physically exist, but it is kind of like in the cloud, and it's represented by whatever the majority of the village ledgers say. So that is kind of essentially what a blockchain is. That's like, what the Bitcoin blockchain is a history of all the transactions ever since the beginning of the Bitcoin blockchain coming online and forming this network. And so what you can imagine, though, is that, of course, with Bitcoin, we're not having villagers who are meeting every day in the town square at noon. We have these computers all around the globe that are running the Bitcoin software. And instead of the cadence being every 24 hours for, batching the transactions essentially, or like putting a block of new transactions on the chain, they do it on average every 10 minutes. And so what is revolutionary about this is, as I mentioned, you don't have one kind of authority for determining what the correct ledger is. But on top of that, what's so interesting is that, Bitcoin doesn't have a CEO, or it doesn't have a board or anything like these banks that currently maintain all these ledgers do. And these banks have hired like IT departments and, different people to make sure that the ledgers are all running correctly, right? Bitcoin, instead, as people most hopefully famously know, the creator is pseudonymous. They go by the name Satoshi Nakamoto. We don't really know who that is. And yet, despite the fact that there's nobody in charge, that there's no CEO, no marketing department, no IT department, Bitcoin has now become a $2 trillion asset, which, puts it in the ranks of, highly valuable stocks. If, I understand, as I said before, it's not a stock, but just to compare it to assets that we're familiar with. And so, the way that Bitcoin achieved that, despite not, having employees to help it succeed in that way, is by building incentives into the way Bitcoin, the coin, is structured. And what I mean by that is essentially every 10 minutes when they attach a new block to the chain, the software will also mint new Bitcoins. And the people who run the software to, make sure, the villagers, essentially these computers all around the globe, when they are doing the work to attach these this new block of transactions to the chain. So first of all, only one can actually be called upon to attach that block, but the way they do it is they all compete. They try to solve this math problem and be the first to solve it. And if they are the first to solve it, then they can broadcast the new block of transactions to the chain, and they will be rewarded with these new Bitcoins that are being minted. And so as you can see, that little incentive right there, this opportunity to win these new Bitcoins, is what enabled Bitcoin to get all these computers to join the network and to run this software. And when they were doing that, they were actually adding security to the chain to make it very hard to hack the blockchain and, for instance, change the historical transactions. So again, this is like, normally you would have an IT department where you were paying them salaries and giving them benefits, and, you have tens of thousands of employees or whatever it is. And yet the way Bitcoin did it was simply having this software that had incentives built into the coin, and people were naturally incentivized to do things that helped the network grow. And that's why, to my mind, Bitcoin and crypto generally are so revolutionary because you can take that same model and you can apply it to other types of cryptos, other types of services on the internet. And when I say service, what I mean here is, so Satoshi Nakamoto, the tagline of the white paper said a peer-to-peer electronic cash system, and that was perhaps their their original purpose was to create a way to actually have cash, but on chain, or online. You will hear the word on chain though from us as well. But anyway, so that's, just a concept that I wanted people to understand, just to, because you probably think, I've heard people say things like, oh, Bitcoin is just this fake scarcity. They just put this cap on it and it can change. But I don't know if people really understand this part of it, which to my mind, that is really revolutionary. And it's something very different that we haven't seen before.
Great, thank you. That's helpful. You brought up Bitcoin. It's received a lot of attention this year, but it's been struggling lately, including today. I guess what's going on with Bitcoin, and what does it mean for the long term?
Yeah, I can take that one, and I think it's important to kind of put what's happening today in the price in the context of what Laura just spoke about, because I think it's really important to understand how revolutionary Bitcoin really is. It's not the first attempt at digital cash by any means. I mean, there's been attempts going back decades. It's really the first one to ever make it work, make the whole system work. An example I used to give sometimes when I was giving talks is, if I gave a dollar bill to Laura or to you, Charles, like, you could be absolutely certain nobody else would have that dollar bill. But if I took a picture of a dollar bill and gave it to one of you, there's no way you could trust that I did not give that same picture to somebody else and said the same thing to them. With Bitcoin or other digital assets, you can be sure. That's the magic of it. It's computationally secure through those miners. And I think it's important to remember how valuable that is. I mean, in certain ways, we are very privileged. I mean, Laura and I both live in the United States. I would imagine the vast majority of people watching here are American. I mean, given the name of your organization, like, most of us are not unbanked. We have access to financial services, investment opportunities, so on and so forth, even if they come with friction and headaches from time to time. Nobody likes paying for wires, but I mean, Bitcoin is a scarce digital asset with 21 million units that can never be changed. And people who say, oh, we can just create a copy, don't understand the mind power, the narrative of Bitcoin itself. And there's a wide world out there, people that live in highly inflationary environments with authoritative governments, and they need to have ways to protect their wealth, digitally move it. That's what Bitcoin can do. So I think it's important to just remember, like, that's the power of it. That's what appealed to me over 10 years ago when I got involved in the space. It wasn't the price, and frankly, the price was really low back then, and I never imagined it would get to where it is today. But what's going on today? So, I mean, just as we were getting ready to come onto this webinar, I was actually finishing a story that's going to go up soon on Bitcoin's price, because it's at, I guess, around $96,000 or so. Earlier this morning, it fell to about $94,000. It's actually fallen so much that I believe it's only up about 1% or so on the year, and that's in contrast to like the NASDAQ 100, the S&P 500, which are up, I think, an average of 17% so far this year. Those numbers are a little bit skewed because, I mean, they're highly driven by like the Mag 7 stocks, the big AI tech stocks. They're the ones doing most of the work here. But some context matters. I mean, Bitcoin a few years ago was $20,000. In the beginning of 2024, when Bitcoin ETFs launched, it was about $40,000. And like, if you knew it was going to double then, would you really care a lot if it was like 120 or 126 or 95? I mean, that's still 100% appreciation. And there's going to be some retracements. This is a highly volatile asset. Volatility doesn't always go up. Sometimes it goes down, and Bitcoin had a lot of wins. I mean, it surged at the end of last year when Donald Trump won the presidency and really sort of aligned himself with the crypto community going back to last summer as a way of, I guess, a marriage of convenience to a certain extent in order to get the donations and help them win the election. And like, it led to a significant increase in the price of Bitcoin, many stocks that are associated and tied to the price of Bitcoin. So I guess it's natural that there was going to be a little bit of a pullback. A few things that have happened this year. I mean, for one, Bitcoin, like everything else, was affected by Trump's tariffs in April and the market fear that was instilled, I guess, in April before it kind of subsided a little bit. But the market is also waiting for that next source of demand. And since that didn't happen, it's been slowly just going down a little bit. There was something, and I think we'll talk about this a little more later on, called digital asset treasury companies. These are essentially publicly traded entities whose primary objective is to acquire Bitcoin and then perhaps try to use it productively, but really try to leverage capital markets to efficiently acquire it in order to drive the prices up. But what's happened, actually, we've read a couple stories to this, is that there's not as much Bitcoin being bought as initially thought, and some of the Bitcoin being moved into these assets are just being moved around from one place to another. So we're waiting for that next real source of demand. And then since that hasn't quite materialized, the Bitcoin, some of the investors in Bitcoin, like the risk-on investors, have turned towards the AI companies, the AI stocks, because they're trading at eye-watering valuations, but they're also, I mean, look at NVIDIA putting out tremendous quarters. They're exceeding analyst expectations, and people are seeing real adoption use cases for AI. So that's sapping away some of the demand. So it's in a little bit of a lull. And we're waiting for what some of those new catalysts will be, and they are coming. We can talk about that more later, but a couple things immediately that come to mind. For one, what's happening in Washington, D.C. In July, the industry saw the passage of the very first piece of major crypto legislation. It was called the Genius Act, and it set the rules of the road for stablecoins, which are dollar-pegged digital tokens. We can talk a lot more about that. But right now, there's a lot of work happening, especially now that the government has reopened, on what we're calling market structure legislation that's going to solve or settle really important questions like delineation, the delineation of regulatory oversight between like the SEC and the CFTC, and sort of like how these things can be traded. And pretty soon they're going to be able to be traded on the New York Stock Exchange and NASDAQ, and it's going to lead to a ton of adoption that way. And then even further down the line, I am anticipating central banks to start buying Bitcoin, putting it on their balance sheet, especially as sort of they engage in the debasement trade and perhaps rotate a little bit away from treasuries and maybe even gold. So there are more catalysts coming, but I suspect it might take a little bit into next year for us to see them, which actually makes for a pretty interesting entry point for anyone listening and watching that is perhaps crypto curious, but did not necessarily want to fall in. No one wants to be the one buying into something at an all-time high when it looks like there might be a little exhaustion. So this pullback of, I think it's about 20% or so over the last 3 months. I don't know if that quite qualifies as a bear market, but I know that 20% figure is a good sort of litmus test. It does provide an interesting opportunity for the crypto curious.
Thanks, Dave. Yeah, it's interesting. So for stocks, we usually use a 20% drop as a bear market, but obviously crypto itself has been a bit more volatile. But you were talking about DAT, the digital asset treasuries. Could you give us a sense, and Laura, if you want to chime in, please do. I guess, how big is Bitcoin right now compared to the rest of the market? And I guess, and what's the correlation like? How does Bitcoin move relative to other assets?
So I actually don't know the current Bitcoin dominance, but I can look this up really quickly. But basically, Bitcoin traditionally has been quite dominant. So essentially, there are times when it's like, I don't know, 60, 70% of the market. There was a period several years ago where it was, like 90%. And what we saw is eventually that began to be eroded when these smart contract platforms kind of took off. And so what essentially was happening there is, just to explain what a smart contract platform is for people, this concept that I described earlier about the decentralization, you can apply that to many different types of applications. So there's a common kind right now that is a so-called decentralized exchange. And what that means is, instead of an exchange being like a closed order book where there's a company that's, matching these buy and sell orders, You instead have this little software program online that is uploaded to Ethereum. Yeah, actually, sorry. I'm going to step back. I'm going to explain Ethereum first, then I'll explain this decentralized exchange. So the creator for Ethereum used to be a Bitcoiner. He's this, at the time he was a kid, Vitalik Buterin, and he was noodling on this problem, which is he was traveling the world. He was watching these different Bitcoin communities try to innovate on Bitcoin. And what he saw them doing is basically saying, oh, well, we can do something similar to the Bitcoin blockchain, and we can add this feature. We can, kind of tweak this chain to add these like additional pieces. And he was thinking, well, wait, so every time a new one comes out that has new features, then the previous one will be obsolete. Why can't it be more like an app store where any developer around the world can upload a decentralized application to a decentralized app store? And that is essentially what Ethereum eventually became. And the way that he made that work is he created a programming language to code these so-called smart contracts. Although the joke is they're neither smart and they're not really contracts. But anyway, what they are is these software programs that run on this decentralized computer of Ethereum, this app store. And what that means is because there's nobody in control of Ethereum, there's no bank that, that you can call to reverse transactions or whatever. Once you upload this piece of software, it will run as what he calls a financial vending machine, meaning I want to, so for instance, an example of this type of financial vending machine would be this decentralized exchange that I started the answer with. So on the decentralized exchange, what's interesting is, as I mentioned, there's no centralized company that is matching these orders. What's instead happening is there are everyday people who they can do what's called provide liquidity in a liquidity pool. And so let's say that they have a stable coin, which is a coin that is pegged to the value of some other asset, and 99% of all stable coins are pegged to the value of the US dollar. So they could put a liquidity pool that has some USDC, which is a popular stable coin, and let's say ETH itself. And then what they do is they create this little equation. They say, I will offer, so anybody who wants to buy ETH, the price needs to stay, or not stay, sorry. See, if you remember how this bonding equation works, the point is, so let's say, okay, they have this kind of equation that sort of keeps, I guess it's the supply maybe constant. And what happens is, so let's say that there's somebody who comes and buys from this liquidity pool and they're buying the Ether. Then what will happen is, because the Ether supply has gone down, the value of the Ether itself will go up. But then, because of, how arbitrage generally happens, when people realize, oh, this liquidity pool, the price is getting out of whack with the rest of the market, people will be incentivized to instead, buy the USDC and bring the price back down according to this equation. So you can have these decentralized exchanges where there are so many people that are offering their coins as liquidity, and they can make fees from offering this liquidity. And basically the software is the one that is enabling these quote unquote orders, I guess, I don't know how to call it, to, executing them. And so point is that, yeah, as I talked about earlier, Bitcoin kind of started as this decentralized way to send cash online, but now you can apply that concept of offering things online in a decentralized fashion to so many additional things. So anyway, I'm so sorry, because I remember that I don't even remember your question or how I got on this topic.
I can help a little bit. So yeah, I mean, Laura, you started by talking about this metric we use in crypto called Bitcoin dominance. It's really just sort of what percentage of the total crypto market cap is comprised of Bitcoin. I was looking it up while you were talking, Laura. It's about 59%. So I can't do math on my head, but I think Bitcoin this right now is about $1.92 trillion. So what 60% of what is 1.92 trillion? Figure it out somewhere. I'm guessing it's somewhere around 3.5, 3.7 trillion, something like that. Yeah. And obviously when this all started, as Laura was saying, it was only Bitcoin, so it was 100%. And then once Ethereum was created a couple years later, it started to go down. And what we tend to find is that during very bullish periods, traders want to rotate out of Bitcoin into what are known as like altcoins or alternative digital assets that tend to have a higher beta, tend to be a little bit more volatile, and are in some ways momentum trades that either go up or down depending on what's happening with Bitcoin. During like periods of peak bullishness, that number can drop into like, I believe like the low 30s or 40s. It's gone back up in the time since because there's just been a lot of focus, especially institutionally, on Bitcoin with the ETFs, the DATs. A lot of major entities like JPMorgan, Goldman Sachs, et cetera, are now creating opportunities for Charles Schwab to let their clients buy these digital assets and also like post them as collateral for margin loans. A lot of really interesting things there. But I think the general trend is that this number should go down. The Bitcoin dominance number should go down over time. It's going to start with things like Laura talked about with Ethereum and this like world computer smart contract platform that can create decentralized versions of everything from Facebook to Dropbox to Uber. And through these smart contracts, which as she said they're not smart because they're basically if-then statements that auto-execute, and they're not contracts, at least in the legal sense of what is a contract. It's just auto-executable code that will work in the way, however it was programmed, flaws or no flaws. But then like over the years, we've seen plenty of other types of innovations that should also decrease this Bitcoin dominance number and create more opportunities for people to engage with this technology and investors to get exposure. Those can be things like NFTs, non-fungible tokens. I mean, a great thing about Bitcoin and other commoditized digital assets like Ethereum or Solana is that they're all fungible. Like if I give Laura Bitcoin, she doesn't care which one I gave her. Same thing with ETH, Solana, et cetera. NFTs, and I'm not talking about like, I mean, yes, there are like the joke ape coins and all that type of stuff there. I guess the ape coins aren't really a joke since they're worth like tens of thousands of dollars, but I mean, there's something like that. Meme coins have been created, which are basically NFTs, but they are fungible. And a lot of other different types of, and now there's like NFTs in forms of things like tokenization, putting real world assets on blockchains. So there's a lot of innovation happening behind the scenes that we track at Unchained, and that should make this Bitcoin dominance number go down over time. But as of right now, especially because we are in a bit of a bearish market at this point, the number's gone back up. So 60, I think it might go up a little higher depending on what's going on with the market, but during bullish periods, I would expect it to be closer to 40%.
Thank you. I know we talked just about Ether, its mother, the contracts. Just, I guess, could you all share some brief thoughts about other aspects of the crypto market? I know Steve, you just mentioned NFTs, not FTeams, NFTs. There's meme coins, DPIN, perps, governance tokens, and probably certainly much more than this list. But could you, I guess, give some general thoughts about those other aspects of the crypto market?
Yeah, Laura, is it okay if I?
Yeah, go ahead. Mm-hmm.
Okay. So yeah, like innovation, I think comes in a couple different ways when it comes to crypto. I mean, for one, different types of assets, different use cases for this technology in our daily lives. And hey, look, we're drinking the same drink. And like that's a really exciting thing to happen because that's where the promise of this technology comes from. The same thing with stable coins, which has become a hundreds of millions of dollar asset class. Where it essentially is putting the digital dollar online, and in certain ways is I think going to prolong the dominance of the U.S. dollar, especially given certain concerns about like what's happening with monetary policy here in the U.S. So that's all really fascinating and exciting. And I mean, those are some of the big categories. DPIN stands for decentralized physical infrastructure. Like for instance, creating a set of online hotspots that wireless hotspots, so that are sort of coordinated and financed through a token, or and like that's one aspect that I know people are also excited about too, but it's in certain ways it's taken a little bit longer to take off because there are a lot of other hardware type expenses that come with creating physical infrastructure vis-a-vis software. But then there's a whole nother set of innovations that come with just how capital markets work, and that's what Laura was talking about a little bit with decentralized exchanges. Anyone who has probably bought crypto listening, I'm guessing you probably did it through a centralized exchange like Coinbase or Kraken or maybe Robinhood. or even if you bought an ETF from like BlackRock or something, like those are centralized entities. And they're really helpful because they're secure. You're not responsible for securing the tokens on your own. There's someone to call if something goes wrong, and they have really nice user interfaces. But this is decentralized. This is crypto. So as Laura mentioned, there's decentralized exchanges, which basically operate similar types of functions to the Coinbases, but they do that without anyone directly controlling them. And that means like directly controlling what tokens get listed, what the prices are, so on and so forth. And because there's a lot of financial engineering happening here, there's new and exciting ways to trade crypto and get exposure to the asset class and manage portfolios, manage risk, et cetera. One of the really big exciting trends that has come up is called perps. Those stand for perpetual futures. I'm guessing everyone here has probably traded or engaged in derivatives trading in some shape or form. And usually those are like maybe a cash settled futures that expire at the end of the month. You can roll them over, et cetera, et cetera. But perps, these are essentially like auto rolling over futures that essentially, I think they roll over between every 4 hours and every 8 hours, depending on how these things are structured, where someone taking a long position either compensates someone taking a short position or vice versa, depending on where market sentiment is at the time. And that's led to explosions in trading. That helps with market order depth. It helps with smoothing out, helps with like smoothing out periods of volatility, and it also gives a lot of great exposure to certain tokens that are underpinning these various perpetual futures trading platforms and even DEXs too. So that's one area that we focus on a lot. This is a huge area of growth, and because in crypto, just like in the spot markets, derivatives are orders of magnitude bigger than spot markets when it comes to things like stocks and gold and commodities and so on and so forth. And that's going to happen in crypto too. So this is a tremendous leap forward in terms of market efficiency and the maturity of trading. So those are just a few buckets, and in this newsletter that we're writing, we're going to focus on each one of them, like depending on what's happening in the market. But like those are just a few different ways of showing how all this innovation is happening, and it's really exciting.
Great. Just taking another step back, I guess you all have been covering crypto for a long time. Anything particularly stand out to you as being memorable or noteworthy?
Like from our time covering it, or?
Yeah, from your time covering it, or yeah,
Well,
exactly.
honestly, like I was just realizing, so with my initial description about Bitcoin being decentralized, it almost paints a very idealistic portrait of decentralization because it worked out quite well for Bitcoin. But as Steve knows, and as anybody who follows the space closely knows, there is an ideal of decentralization that is often not adhered to. And not only that, but it's almost like impossible for early stage projects. And so what we see is that there's actually this kind of interesting thing that's happening right now where because these projects are newer and it would be very hard for them to be truly, decentralized, where the community is kind of trying to direct the progress of something, like simple things like, what should the fees be on this decentralized financial service for, whatever it might be, like borrowing and lending, or, whatever. Those can be done through these governance tokens that were briefly mentioned earlier. And what that means is, let's say that you own the tokens for, one of these borrowing and lending protocols like Aave, which is the biggest one. As a token holder, when there are proposals that go up in the community, these communities, by the way, are called DAOs, which stands for Decentralized Autonomous Organization. But they're not like autonomous, but anyway, what you can do is with your tokens, you can vote, yes or no, I want to adopt this proposal, or, whatever it is. But in the very early stages, when it's trying to get off the ground, they tend to be more centralized. And even the bigger ones now, there's probably still some element of centralization. And so what ends up happening is that we do sometimes see, not even sometimes, we do frequently see that there are these people who will talk a good talk about what they're building, but secretly behind the scenes, they can control things in different ways. And basically, a lot of them will abscond with the money. And in crypto, that is frequently called a rug pull, where it just is what it sounds like. You get the rug pulled out from under you. And maybe you have put money into this project to support it, like you thought the vision seemed compelling, and then all of a sudden, oh wait, actually they can, they have a little backdoor in the smart contract, and they can just pull your money out and never be heard from again, and you don't know where they went, and who knows. So I just wanted to put that caveat in there about my comments earlier about decentralization, because I do think the concept is super interesting, and I do think it will create revolutionary changes. And I do think that there are already so many people who have benefited from certain things being decentralized, such as Bitcoin. But it's not always the pretty picture I painted. Just one example that I wanted to pull out in that regard, because I do frequently hear, particularly people like in the US and Canada who basically are financially privileged. They often don't understand like why crypto is important, or they kind of maybe look down their nose at it or whatever. But I've had people on my show, like I had this Afghan entrepreneur who's actually quite famous. She did that girls robotics team from like 2017 or 2018 that came here to the US. And she's kind of a serial entrepreneur. And back in 2013, she was doing this like blogging platform where people could upload their blogs, and they found that they had a hard time paying a number of their bloggers, because especially many of the women didn't have bank accounts, or even if they did, their male relatives would actually maybe confiscate their earnings. And so what they did was they set up the women with these Bitcoin wallets and taught them how to use them. And then they paid them that way. And then that just gave those women a little bit more financial freedom. And she actually said that one of the women who had been in an abusive marriage was able to save up the Bitcoins and actually, finally divorce her abusive spouse and, essentially attain freedom. So, there are, once you get more into crypto, if you choose to do so, you will find that there are certain geographies around the world where there's more crypto adoption, and it is precisely because of the fact that perhaps their local currency or their local economy is not a great one to be a part of. And so you will find out, for instance, that Argentina has a huge crypto community, because for those of you who are unaware, that country has experienced hyperinflation multiple times. And so, there's just, I think I think sometimes if you live in a world where you have easy access to credit cards and bank accounts and different apps like Venmo and Robinhood and, whatever, it can be hard to see. But yeah, there's been a lot of benefit from these things.
Yeah. And I mean, just to follow up, I mean, Laura, I think there's very little that Laura and I haven't seen. I mean, frankly, like she was a bit of a hero of mine for a long time before we met, because I think, Laura, you launched the very first crypto podcast, or at least the very first one I ever listened to. I mean, there
were some there were like 3, but one was super technical that like most people probably couldn't follow. And then the other 2 were more like talk radio.
Yeah. And, but yeah, I mean, we've seen everything. I mean, I've been involved in crypto one way or another since 2012, 2013. I mean, back when I used to be a senior intelligence analyst for the Pentagon, I used to joke on panels that I was one of the first people probably to take a polygraph test who worked in crypto, because that was part of my job at the Pentagon. And I mean, we've encountered so many crazy characters. I mean, I wrote the famous Forbes profile on Sam Bankman-Fried that has aged extremely well. I kind of mean that in a joking way, but like I got to visit him under house arrest when he was in San Francisco. He used to call me at night, and actually he would call me at night and wonder why the press was being mean to him, and why they weren't telling his side of the story. And it would really annoy my wife, because she's like, why is he calling you at like 2 o'clock in the morning? And I don't know, he doesn't sleep anyway, and he's in California. I mean, we've seen Yeah, I mean, we've seen the, I think really one of the things that we've seen both is that we've seen the resilience and growth of an industry that up until very recently not only had like a not interested or uninvolved government, but an actively aggressive one or hostile one to it. And the people in this industry continue to build, continue to grow. As Laura said, I'm not trying to say that every single one of the people in this industry are good or doing sometimes the right things, but the vast majority are, because we all believe in this idea of decentralization and the idea of sort of middling out some of these rent seekers and trying to create fairer and more transparent and more efficient financial rails for everyone. And the real trick is just trying to help everyone kind of see through the noise, trying to understand like what are the trends, the growth trends that you should pay attention to. How do you make sure you're not scammed? How do you make sure you don't fall into the traps Laura said? I was at dinner last week with some friends, and they're asking me about some project that they're like, everyone's talking about this. And I asked them to show me what it was. And I'd never heard of it. I think, Laura, we were talking about yesterday, you'd never heard of it. And they showed me the article from some outlet I'd never heard of. And in the article, it had links to buy the token, it had links to the project. And like, as professional journalists, those are telltale signs of not journalism, but some sort of like fake sponsored content. That's actually one of the benefits that people here will get if they subscribe to our newsletter, because frankly, there's very little that Laura and I have not seen, and if we haven't seen it, it probably means it's not legit. And two, you could even like call and ask, especially me, about these things to understand, to just like have a quick check and make sure that you're not going to do something stupid with your money. But yeah, it just, I mean, I love this industry. I've been in it for 12 years at this point. I don't really have any plans of ever leaving. It's because of like how much passion there is about this, that in spite of everyone on the outside saying you're a joke, you're not going to become anything, they're winning converts from the Jamie Dimons, from the Larry Finks, from people in the White House. And that's just because of hard work and continuing to believe in what was created when Satoshi Nakamoto wrote the white paper, or published it, I guess, on Halloween night 2008.
Great. And you know, you just mentioned Sam Bankman-Fried, and even right before we started the webinar, we're talking about how the regulatory environment has changed under President Trump relative to President Biden. And so I just wanted to ask you about, you know, what is the current regulatory status and what's likely to happen? And we also, one of our members who's listening in asked point blank, one of the base concerns has been a lack of regulation in trading currencies with potential fraud. Could you update the audience on some of the laws and regulations that I believe were implemented earlier this year?
Yeah, I mean, I think one big misunderstanding about crypto for years is that people said it was unregulated. I still hear members of Congress say it's unregulated in a pejorative tone. I mean, that's very much not true. I mean, going only back to like 2013, I mean, FinCEN was talking about how anyone engaging in like accepting fiat currency for crypto has to be BSA compliant, so on and so forth. But up until this new administration, most of the action in DC has either been like the IRS issuing tax guidance for how to like handle capital gains, or so on and so forth, or what was called regulation by enforcement. The SEC under President Biden's chairman, Gary Gensler, who actually came in with a lot of hopeful expectation from the community, almost became the boogeyman, because he sort of just decided to start suing every single project and exchange, or meaningful project and exchange in existence, and a little tongue in cheek there, for essentially violating securities laws. And the core basis of these different enforcement actions was that pretty much every asset other than Bitcoin and perhaps Ether was a security, because according to this decades old judicial precedent called the Howey test, they were not sufficiently decentralized. Frankly, the concept of decentralization is still a moving target, but he basically said that they're all breaking the law because you're trading securities, but you don't have a broker-dealer license and you're not registered with the SEC. Ever since President Trump came in, though, those actions, and this has led to some criticism. Those actions were basically all withdrawn or paused, because the government now is trying to create actual laws, rules of the road to sort of settle all these lingering outstanding issues. The first one, as I said before, what's called the Genius Act, and that really set the rules for stablecoins. This is basically the oil or the liquidity for the crypto industry, because most cases, if you're going to buy Bitcoin or Ether or whatever, you can still do it with a credit card, you can still do it with cash, but especially professional traders use these blockchain-based stablecoins so that you don't have to move money on-chain and off-chain, which can be slow and expensive. So they basically set rules like who can issue them, what types of requirements are there for the collateral. For instance, you can't issue a stablecoin and then go buy a bunch of stocks that could drop 20% or back it with crypto. You have to basically hold cash or cash equivalent securities like US Treasuries. So there's a lot of stuff like that. But the real big prize, the brass ring that we're going after, is market structure legislation. I said in the beginning that's going to first focus on, excuse me, I'm just getting sick. Like delineating between the SEC and CFTC. The CFTC oversees commodities, and under this current new SEC and Chairman Paul Atkins, he's already said most crypto assets are commodities in his mind. It's kind of interesting because historically, like the CFTC is not necessarily a spot commodities overseer, because there's not the same type of spot market for commodities like gold and oil that there is for stocks like the New York Stock Exchange, because it's much of a bilateral OTC basis for commodities. But with crypto, now there needs to be. So the CFTC is going to be buffed up to have the resources to oversee this type of market. There's going to be things like thresholds from when a project might go from being centralized in its sort of embryonic stages to decentralized. There's going to be rules again for security. There's going to be rules on how these things can be traded. There's going to be rules on who needs to register where to be able to trade. So it's going to do a lot to legitimize the industry. There was hope that this was going to be signed this year. That hasn't happened. I mean, for one thing, any legislation is complicated. This is extremely complicated, and it was all gummed up because of the shutdown. The House of Representatives actually passed its version of the bill. They called it the Clarity Act. I forget which month, Laura, maybe you know, but it was sometime in the last couple of months. And the Senate has been trying to work on its own version. There's a couple of different versions of this bill floating around the Senate, so obviously they need to get on the same page, come up with one on their own. It's going to have to be reconciled with the House version, because I don't believe they're going to be exactly the same. And then it's going to have to go to President Trump for signature. This continues to be a major priority for the industry, and also for DC and President Trump. I mean, I'm sure everyone has read stories about how much money was donated during the last electoral cycle to creating a pro-crypto administration or pro-crypto Congress. So they want to kind of deliver on what was promised to get those funds. But when that happens, it's going to make the industry safer for people to engage in. It's going to make the industry just a lot more mainstream. And when I say safer, and this is the last thing before I'll shut up and let Laura talk, doesn't necessarily mean it's going to be less volatile. Yes, maybe as the industry becomes more mature, but what we really want for anyone investing in anything is the only risk you really get exposed to is price risk. You don't want to worry about things like information asymmetries. You don't want to worry about things like security. You don't want to worry about things like bad actors. And this legislation will go a long way to removing a lot of those concerns that I hear about all the time, and that still unfortunately afflict innocent victims from time to time.
Yeah, something important that I want to mention when it comes to that bit about the previous SEC under the Biden administration is that, Steve mentioned that the laws that they were referencing were decades old. And the reason that the industry had a lot of concern and frankly, just pushback against how the Gary Gensler SEC was trying to regulate crypto is the fact that when you looked at those laws from the 1930s and 1940s, it just raised so many questions about how it applied to these what I talked about, these financial vending machines, where those regulations from the 1930s and 40s presumed that there were intermediaries that were facilitating these transactions or that were custodying the assets or whatever it is. But when it's software on a blockchain and you don't necessarily have somebody who is controlling that, then it raises questions about, well, who does the regulation apply to? Like how do you apply it to something that's such a different animal? And that SEC, the Gary Gensler SEC, they refused to answer those questions. And they would say things like, oh, these crypto companies are not coming in and registering. But we're talking to our sources and they're like, we have tried, but we cannot get our questions answered about how to do it because what we're building is so different. And so it was kind of like,
I'm sorry, I didn't mean to interrupt, but like some even told us like it's impossible because like how can a open source project file like an S1 or something like that?
yeah, like, and they did not answer these questions. And so, what was so interesting was during that time, because all these entrepreneurs were worried that suddenly this enforcement action against them would come down and, tie them up in all these legal fees, whatever, we just saw so many entrepreneurs just flat out leaving the US. And so there's this report that goes out that kind of tracks, the development of crypto around the globe. And yeah, crypto the US used to be the #1 place for crypto entrepreneurship, and it's now third, which is a little bit disappointing. But this question really about how to apply those laws and about, frankly, what is the security versus what is a commodity, that held up development of crypto in the US for such a long time. And what's so interesting about it is, it really comes down to just what we talked about, just these rules around registering and whatever. It's sort of like a bureaucratic step. But other countries, they do not have 2 regulators for securities and commodities. It's all just under one agency. And so what it kind of felt like, frankly, covering it, is that it amounted to essentially a turf war between these 2 agencies in the US, whereas other countries that just have one regulator for all securities and commodities, or whatever it is, they don't have these questions. And so the regulations just kind of moved a little bit more quickly in those countries. And it almost felt like here it just got super political. And in the end, what ended up happening was there were multiple judges that just ended up ruling again and again against the SEC and calling their decisions arbitrary and capricious and things like that, which is harsh words, saying like you're basically making your arguments up out of thin air and they are not something that can be reasonably followed. And so you will find basically, so or at least my experience from when I started covering this in 2015 is that for the longest time, I don't think I knew anybody's kind of political leanings, or there was no sort of, I don't know, it was just like learning about crypto, basically. But then what happened is, as the Biden administration went on and people were getting increasingly frustrated that the US was falling behind and that crypto companies, it was having a chilling effect on entrepreneurship because of the cost involved, the legal costs involved with like dealing with potential enforcement actions and things like that. So yeah, there was a period where the crypto community kind of, that's why you will see there are certain members of the community who are virulently kind of, pro Republican now. And so anyway, it's sort of like, yeah, that administration was not neutral in my opinion as a journalist, and as an American, it was kind of frustrating to watch because I was concerned about us potentially not leading on the cutting edge of finance and technology, which, if we look at like, how the internet has played out, it has benefited the US tremendously because all the biggest internet companies are American companies. I mean, it's, Google, Facebook, Amazon, Netflix, whatever it is. And I just was getting concerned, like, am I literally watching the demise of the US like happen in front of my very eyes? So, who knows how all this will play out, but all I'm trying to say is that, some of what Steve said there about like applying those old laws, I just wanted to explain like why it was that was such a weird fit, and it just was kind of its own can of worms that they just basically refused to address.
That's helpful. Since you're mentioning the laws and technology and really falling behind technology, I wanted to ask you about security, and obviously there have been some hacks. And we've actually gotten a few questions from attendees. One of them actually mentioned technology evolution, asking about the rapid evolution of quantum computers and their ability to hack an account. Another person asked, if you use someone like Coinbase and it gets hacked, what happens? And that obviously ties in with the regulations. We all know that our bank accounts are backed by FDIC. The SIPC backs our brokerage accounts, but crypto, with its low regulatory stance, you don't necessarily have that backing. So I guess if someone's looking at investing in crypto, I guess in terms of securities or anything they could do to protect themselves, or anything they should keep an eye out when investing in digital currencies and other crypto assets?
Yeah, so I have thought about this a lot. So I think what's good is if people, you know, the way that you might pay like $200 for a course or something, you can spend $200 to teach yourself how crypto is different from the money in your bank account. So, or any other digital money that, you know, we traditionally interact with. And what I mean by that is, as I mentioned earlier, you know, the Bitcoin white paper has that subheading, an electronic peer-to-peer cash system, right? And so what that means is if a Bitcoin transaction is made, meaning from your quote unquote account, or really it's your wallet, that you didn't make, you cannot go to the bank and ask them to send it back to you. There's no like chargebacks, because it really functions like cash. The only way that it will come back to you is if the person who sent it out of your wallet chooses to send it back to you. So, you know, this is something that you have to wrap your mind around. And so this is why, for instance, like, you know, this actually goes back to the FTX scandal, frankly. I have found that one of the things that Sam Bankman-Fried was doing in his little publicity tour after the collapse of the FTX was kind of trading a little bit on this confusion in the public about how a crypto exchange should work versus a bank. And so banks, as probably most of you know, they have a fractional reserve system where they will take your deposits and then they will lend out some portion and they will make money on that. And so they, you know, just keep a fraction of what they actually owe to their customers, assuming that, you know, nobody's going to come and demand all the, or that not all the customers will come and demand all their assets at the same time, right? And that's why we have this concept of a bank run. So in crypto, for a crypto exchange, a bank run should not be possible, because what an exchange does is, because of this fact of how it functions like cash, that, you know, once it leaves, you cannot force somebody to send it back, because there's no centralized entity controlling, you know, the movement of this money. They function more like a Fort Knox, where what they do to keep your assets safe is they will literally create this whole fancy setup. It's very almost like ritualistic and yeah, futuristic, where they have what are called air-gapped computers or drives. And what that means is these are also known as cold storage. Cold storage means not connected to the internet. They might have some servers that are also what they might call warm storage, which is only occasionally connecting to the internet. And then they have what are called hot wallets, which are constantly online. And the hot wallets are riskier. So you could almost think of it as like your checking, where you're going to keep an amount in there that you know you sort of need, you know, on an operational basis. And then maybe the cold storage is like, you know, your retirement account or some kind of savings that you don't touch. You know, you can think of it like that. And they set up all these systems to, and the reason, of course, that it's cold storage, not connected to the internet, is because they don't want it to be easily hacked. And because of that concept of how then they will, they literally don't have the money to give you, and they will have to pull it out of their own reserves or whatever. And then the warm is just, you know, operationally, sometimes it might be just easier, rather than trying to pull additional cash into the hot wallet from cold storage, they might just keep some in the warm wallet. So anyway, point is that, you know, for that reason, you should also kind of have an awareness of how you need to keep your own crypto safe. And so, for instance, you know, you can't just avoid keeping a hot wallet unless you decide to never transact in crypto and only invest for the long term and just, you know, whatever. But if you are going to use a wallet, then now there's different ways of making sure that the money remains safe, which is, for instance, you know, a biometric type of security where it's scanning your iris or whatever is happening. And so, yeah, the technology has improved, but what I would urge people to do is, you know, Try to get a little bit of, it can be Bitcoin or a stable coin or Ether or whatever, try to send it, between wallets, try to maybe participate in borrowing and lending in DeFi, or maybe try to mint an NFT somewhere. There's, just like different things that you can try to figure out what to do. Maybe you buy a meme coin, or maybe you swap a meme coin for Solana. Yeah, there's like a lot of different things that you can try to do, and you can just use a little bit of money to sort of educate yourself. And then through that, you will learn behaviors that will help keep your money safe. But the last thing that I will say is there is a pretty common scam that I just want to let people know about. Actually, I'll mention two. One is, if you like become, it doesn't even matter. You don't have to become known for being into crypto, but as everybody knows, you can receive phishing links. And this is a really common thing that happens in crypto where, maybe they make a website that looks exactly like Coinbase, but then there's a little funny character on one of the letters that you don't notice, and so you don't realize that you're not on the actual Coinbase, or, whatever it can be. There have been scams where, for instance, scammers bought Google ad links for popular companies. And instead of, scrolling down to click the organic link, if you click on the scammer's link, then yes, they can take your funds. But the other one that people maybe don't know about that is really interesting is, sometimes you will use like SMS, or sorry, 2FA via SMS, like text message on your phone, like as a second factor for when you log in, right? And what has been happening actually for longer than really should be, but it's human nature, is that scammers will steal your phone number so that your phone number is now going to their device. Then they will try to log in as you, hit forgot password, and then the forgot password will ask where to send a code, and it's going to your phone number, which is now in their, they're receiving all your messages now. So what they will do is they will use it to lock you out of your, they'll change the password, and so to something that they, only know, and then then they can move the funds out. So I'm not trying to scare people. I'm just trying to explain, these are things you should be aware of. But I think ultimately what will end up happening is that there will be multiple ways that people will use crypto or own crypto, and some of them will be ones where you want another company to hold, like a long-term investment for you, such as, if you buy like a Bitcoin ETF or, whatever it is, they're going to be the ones who are going to be worrying about keeping that safe. But then there might be other things where you want to transact, like with stable coins or whatever. And then so you learn the behaviors for, dealing with a wallet and not falling prey to these types of scams. But yeah, hopefully I'm not scaring people. I'm just trying to explain that because this technology is new, that the scammers have been preying on the fact that it requires a little bit of education around how to treat it differently and how it acts differently from, like your Venmo account or your Chase account or whatever. And just to explain that, yes, there is a little bit of a learning curve.
I just want to add to that real quick. We're all probably getting those messages, random messages. Hey, do we have dinner plans tonight? I tried reaching you, weren't available, just from random people. There's actually known as pig butchering, and what some of the scammers will do is they'll try to actually engage in conversation, potentially say, oh, I hit the wrong number, we're trying to engage in communication. And then at some point, it's not incumbent for them to try to have you install some type of crypto app on your phone. And just realize that anytime you get a message from a scammer, they start trying to engage you in conversation, realize right off the bat, that's not someone trying to be friendly, that's someone trying to engulf you in a scam. So it's just beyond crypto, just be cognizant of it and be aware of it. And if you get a message from somebody you don't know, don't respond, just delete it.
I just assume they're lonely and they want friends.
Yeah.
No, I would just echo what Laura said on the security. I mean, there are new security threats because crypto is a bit new, but there's also like just practicing good security hygiene, like you do with bank accounts, is really helpful. Like don't do things like reuse passwords. As Laura mentioned, use two-factor authentication, but don't use your cell phone. Like use like the Google Authenticator app or something like that that can't be hacked. The type of the hack Laura was talking about was called like a SIM swap attack, where like the phone number goes to a different device. Like there's ways you can fall victim to that. Exchanges should be secure. Like they should not be prone to bank runs, like she said. Sometimes it's hard to know though. I mean, FTX, Sam Bankman-Fried, they portrayed themselves as being completely collateralized, and clearly that wasn't true. I mean, exchanges, Coinbase, Kraken, some of the big ones that have been around for a long time, they have tremendous security procedures. I actually used to work at Kraken, and I used to work with their security team to the extent that they would let me to understand like how they have backups and need multi-factor authentication, so people sign up, have to have several different people sign off for big transactions, stuff like that. But really, and exchanges do have insurance from time to time, but one important distinction to make is that that insurance usually does not apply if you let yourself get hacked. Like if you fell victim to a phishing scam, Coinbase is not going to reimburse you. If Coinbase got hacked themselves, then they probably would. But like that's something important to remember. But it's the same stuff as like keeping your bank account secure or keeping your credit card secure. Like there are certain things that are unique about it, especially if you start taking direct custody of your own assets on a crypto wallet. But other than that, like just using the same security hygiene. And for people listening here, now's a great time because there's a ton of ETFs that you could buy that offer exposure to the vast majority, like 90+% of the total crypto market cap, that you don't have to worry about any of this. It's BlackRock's problem or Canary's problem or whoever. And then I just wanted to touch briefly on the quantum computing question, because that is something that the industry is thinking about a lot. I am too. I have two quick answers. One, TBD, I know people are working on it. And two, if quantum computing is able to break Bitcoin's encryption, we have much bigger problems, because Bitcoin uses the same encryption as bank security and pretty much everything else in the world. So if and when we get to that point, whether or not your Bitcoin gets hacked is probably the least of going to be your concerns. But I can tell you that that is a very popular topic right now in the industry. I am not a cryptographer, so I'm not smart enough to explain exactly what they're going to do to address it, but I know it's something that's being worked on well ahead of the time, and I think it's probably at least like 10 years plus before that's really going to be a threat. So I know that that's something at top of mind to make sure that there's a fix in place, updating encryption algorithms or something so that it doesn't happen. But usually, like I said, if hackers are able to break that, like your Bitcoin balance is going to be the least of your concerns.
Got it. I know we're running a little bit over the hour mark. I wanted to ask you what some of the top misconceptions about crypto are.
I mean, I actually think we probably addressed a bunch of them. I mean, one of the big ones is that there's nobody running it. I still get this question a lot. I know, Laura, you were mentioning it too. Like your friends want to buy stock in Bitcoin, or who owns Bitcoin, or who issues Bitcoin, and the answer is nobody. Like I think that's the magic.
Yeah,
that's the
it's
magic.
A software program.
Yeah, I mean, it's I mean that's probably a big one. Another big one that we talked about too is that it's unregulated. That's not true. It's never been unregulated. I mean, granted, there's times when maybe guidance could have come a little bit faster, but if nothing else, it was always regulated under like AML, KYC laws, BSA stuff, and that's just in the U.S. I mean, countries all over the world are doing it too. And
yeah, it was regulated. That bit that we talked about before about, finally we have the stablecoin bill and now we're going to get market structure. It's just that a lot of that had been like guidance, like applying existing laws. And this is the first time now under the Trump administration that we are actually getting laws that are tailor-made for crypto. So before it was definitely regulated, but now it'll be like more specifically like bills written for crypto.
Yeah, that's a good point. Good clarification. And then maybe the last one I would mention, then Laura, you might have more, is that like it's only used by people that want to hide what they're doing or do illegal things. Like I'm a big believer in privacy and privacy tech, and Bitcoin is not as private as maybe some people think, but it is certainly more private than maybe actually using a bank account. But you'll hear stories about crypto being used for some sort of, horrible stuff sometimes, like child pornography or child sex trafficking, really bad things. Obviously, nobody supports that, but like we'll see tons of stories, data, surveys coming out showing that like less than 1%, less than 2% of all crypto transactions involve something illicit, and that many more times are a lot more illicit activities financed by cash and the US dollar than crypto. So this is not just a haven for people trying to hide something illicit that they're doing. The vast majority of people get into this industry for the right ways. And the industry is always working hard, because Laura and I, we know all the people, they're working hard to make that number zero. It's not, but it's a very small, very like low single digit minority of transactions that are used for that purpose.
Yeah, something that's sort of funny to watch is that there are so many former prosecutors who now work in crypto, and they fell in love with crypto while working for the government because they were able to track crypto crimes so much more easily than through the traditional banking system. So with the traditional banking system, they would send like, I think it's called like an MLAT or something. I forget what that stands for, but basically, like, let's say they're doing some kind of investigation. They have to send this letter to the bank, and then they have to wait for the bank to respond. And then all they have at that point for whatever information they got is just one hop in this, series of transactions. And then, then they have to go to another bank. They have to wait. And this can take months. And so these investigations would just like span forever to try to get to all the hops till they finally find a name. And what they found when they started covering crypto crime is, oh my gosh, I can go to a website and I can see the money moving, and I can see where it's going, and I can see like, this is a really fascinating story. So back in the days of the Silk Road, which was this online drug marketplace that sprang up because Bitcoin existed, before if you were going to buy drugs, you had to buy them from somebody in person, because otherwise, like your credit card or your bank account or whatever, like that would be tracked, right? And so you had to pay in cash to keep it anonymous. And so Bitcoin was kind of the first time that you could have a similar kind of cash-like experience, but online. And what happened was, the government did their investigation, and then they ended up confiscating the Bitcoins from Silk Road. And what was so interesting is that eventually it was figured out that there was somebody in the government who actually was stealing the Bitcoins from the government, these Bitcoins that they had confiscated from Silk Road. And this prosecutor ended up so somebody tipped her off to this, and she initially was like, oh, like, I'm going to accuse kind of a colleague of mine. And she basically initially set out to prove them wrong. And here was the funny thing. When she looked at this information about how these hops, the transactions were happening, she realized, oh my God, we not only have somebody who's stealing money, but we have two people in government who are stealing the money. And the way she knew that is because the way these transactions happened were totally different patterns. There was one person who was very meticulously like doing a test, and then, sending a little amount. And then they were, I don't remember all the details about how they were doing it, but the other person was kind of YOLOing, the full amount, like whatever. And it was just, she saw these patterns are completely different. These are totally different people. And that was how she figured out, oh, there's actually two people that are stealing this money from the government. So the point is that, yeah, now she's a crypto VC. There's multiple of these former prosecutors who prosecuted these crypto crimes who now all work in crypto, and they will all tell you any day they would choose to track a crypto crime because the tools that they get, like, here's actually one other really, really interesting case. There was another one where this was a very, very old hack. And at the time of the hack, it was 2016. So, the Bitcoin price was whatever, like probably, I don't know, $600, or I'm not sure, but something, at the time, the hack itself at the time was something worth like 70 million. And of course, as you could imagine, the amount that they stole ended up just ballooning to, whatever, like a billion or multiple billions. And what happened was that the government actually was watching them in real time. They were seeing like, oh, they're converting this money so that eventually it becomes like a Walmart card, or they can use it to like pay for their Uber or their hotel. Like, they're literally seeing in real time how this money is being transferred and what it's being turned into. And they had never experienced that before, where they could literally track the behaviors of the criminals in real time. And they were just floored by that. They loved it. So anyway, yeah, it's very interesting.
Yeah, immutable means immutable. Like, even if they can't figure out the crime right then and there, you can't cover your tracks. Like that's the whole point of crypto in a way. So yeah, law enforcement loves it, as you were saying, Laura. Like the whole trail is right there for anyone to follow.
Yeah.
That's great. Thank you both, Laura and Steve. Sure, attendees, I'll let you give you a few final thoughts here real quick, and we'll go to one more member question. But I just want to explain, part of the reason we reached out to Laura and Steve is that there's been a lot of hype about crypto, as everyone's aware, but really there's not been much objective, helpful information. We've certainly heard from many AI members who are asking us to help them better understand crypto. And that's why we actually are partnering with Unchained. We specifically reached out to Unchained because of their experience and their expertise. As I said before, Steve's written for AI. He's presented for us. Laura actually is one of the first journalists to cover crypto in any serious and consistent manner. She both started at Forbes, now are both at Unchained. Both are educator and journalists. But the other thing is they cover crypto the way we cover stocks, and you've heard them discussing crypto, from the experience, being objective about it, approaching with a lot of skepticism, rigor, but also focusing on what does it mean for individual investors. And with our Bits and Bits newsletter, what you'll get is you'll actually get a newsletter that cuts through the noise, cuts through the hypes. It'll help you understand digital assets and how they impact your overall portfolio, your existing investments. They'll also help you understand what role crypto has, what type of role does crypto have in your portfolio, and also what specifically in crypto should fit in your portfolio and what should not. But most importantly, this is really about educating you, giving you the ability and really empowering you to make smart decisions about your portfolio and about crypto without having to rely on speculation or the constant fear that's missing out. And we all hear people trying to promote crypto and other assets from that FOMO standpoint, and they'll really help you get a better sense of how to approach it in a really objective manner. Jenna, do you want to add anything?
Yes, definitely. I think you were spot on. We're celebrating our launch week this week, so we have a special offer. I've dropped everything into the chat. As far as we're starting off with a really good discount on a one-year subscription, but then we also are giving, because we appreciate your time and that you took the time out of the day to watch and attend today's webinar. So we're also giving another 25% off discount for everybody who attended today. But Charles, you're spot on. Launching Bits and Bips, I think, has been kind of a passion project. We're so happy to have partnered with Unchained. And we're really excited about the high quality content that we're going to be producing, for the future. I know there's a lot of great, content that we have planned for the rest of 2025 and then into 2026. And we plan to release about 2 to 3 articles per week. And there's, we'll have webinars throughout next year. You get a dedicated email with the newest articles that come out as soon as they do. It's timely content. As soon as Steve and Laura send it over to our team, we're posting it so that you can have the most up-to-date resources as possible. So that's kind of what is, I think, as our forefront. But I did want to, just before I go into more kind of like logistical information and stuff, Steve, Laura, do you have any last kind of comments or anything that you want to leave the audience with?
Well, I just want to say that, so Steve is the main writer and editor for the newsletter, and I honestly was just so honored that he wanted to join the team here, because he brings such a wealth of information and experience, and it's kind of the right mix for this moment, I would say, and for crypto. As you talked about, he has this, national security background. He also worked at Citibank. He also worked at a crypto exchange. He was at Forbes for a long time. So, all of those things kind of blend together to really give him kind of really sharp insight into where crypto is going, because as you probably are aware, it's becoming much more geopolitical, and we are seeing that it is affecting obviously our own government at the highest levels. But not only that, it is affecting sort of the world in the future, and kind of the balance of power. And the way the world is going. And so I feel like Steve's past experience kind of like really helps him cut through the noise on that and see things that other people can't see. It's like that Scott Adams saying, I don't know if you know this, he will say things like, successful people kind of take two talents and combine them in a way that's not common, or he probably has a pithier way of saying it, but you know, I feel like when Steve joined, like I really could feel that with him. And you know, he's the main author, as I mentioned, of this newsletter. So I just really hope that, you know, you can all appreciate just what a unique individual he is and what kind of insights he'll be putting in this newsletter.
All right, well, I'm blushing a little bit, but thank you for that. No, I just want to thank Charles and Jenna and the AAII for wanting to work with us on this. We're really excited about it. The content you'll get, it'll be a mix of, like, again, like market stuff, like what's happening, especially on days like today when there's some significant movements. There'll be some like features like in-depth analyses, investigations that you're not going to get anywhere else and are not available for free on our website either. Also a heavy dose of educational and remedial content too. We know better than anyone that the education, the learning curve for this can be extremely high, even for financially savvy individuals. So I'll put out plenty on that, and there's no dumb questions at all. As a journalist, that's a rule that we have to have, Laura, because we always have to, I find myself apologizing at least once during every interview I do. I'm sorry, this is a dumb question. And then they'll say, no, it's not. Frankly, I don't care if it is or it's not. I need to understand, and people who read this stuff need to understand too. Actually, we'll have some way also for, especially like if you're worried about a scam or you're curious about some token I don't write about, like what do I think about this? There'll be a way for all of you to directly contact me as well, and I can always just like send some personal messages or research something for a few minutes just to help. I mean, there's been plenty of times, especially when I was at Forbes in the past, where I ran a similar type of thing where there was even once or twice where I helped people try to recover money that they had stolen, because I have like direct contacts with the exchanges, and I can sometimes get them some access that you wouldn't get otherwise. So yeah, just with that, I'm really excited to be working with all of you, and excited to start writing and meet everyone who will subscribe.
Excellent. Well, thank you to Laura, Steve, and Charles for really guiding us through today's event. We had a lot of questions that came through. I really appreciate the high level of questions and just how engaged everyone was today. Like I mentioned, you know, we could only get to so many. We hope that we were able to answer, you know, as many as we could. But if your question wasn't answered, feel free to email us at bitsandbips@aaii.com. And I put that in the chat several times, so you can just copy it and send us an email. And any kind of emails that we get, we'll also direct over to, and Steve will help us answer anything that are mission critical. So please, you know, feel free to email us at bitsandbips@aaii.com. And then I just wanted, you know, to reiterate that, you know, we're celebrating our launch this week. We launched on Tuesday and we couldn't be more excited. Just to kind of preface, we had our first article go out last night. So we're, you know, in order to celebrate, we're offering all our webinar attendees a special discount today. So if you want to subscribe to a one-year subscription, is on sale for this week only for only $2.99. It's regularly priced $3.49. But today we are also giving, like I said, an additional 25% discount when you use the promo code webinar25 at checkout. And then this promo code is only available until November 19th. And so all you have to do is visit www.aaii.com/crypto-webinar, and that landing page is specifically for our webinar attendees who attended today. And then if you have any questions, like I said, you can also call us at 312-676-4307, and that's Monday through Friday, 8:30 a.m. to 5 p.m. Central Time. And then lastly, because we have a lot of questions that came in, I know a lot of people were very excited, but some had to drop off early. This presentation was recorded and a replay will be available at aaii.com/webinars later this week. And it will also be accessible via our YouTube page. And then webinar attendees will also receive an email from us with a link in the next few days. You'll also receive a copy of the handouts provided during today's events and any other resources that we think are important. And with that, we wish all of you viewing good health, good fortune, and a great rest of your afternoon. So thank you so much and take care.
Thank you.
Thank you.